In this presentation, we will take a look at the concept of depreciation as it relates to taxes, particularly focusing on small business income, self-employed businesses, sole proprietors reported on Schedule C. Depreciation will typically be considered an ordinary and necessary expense, one that can be deducted on the Schedule C for a business and lower the taxable income. The concept of depreciation will differ a little bit from the tax code, however, to financial depreciation. On the financial side, the depreciation, of course, is to make the financial statements as correct as possible for decision-making purposes. When we move to depreciation from the tax code, we have other incentives. The other incentives being the tax code might want to stimulate the economy in some way or something like that, and therefore the calculation of depreciation will differ. So in other words, what happens with depreciation is we're going to purchase something for business that's going to affect a longer period of time than just one period, something like, let's say, a forklift. If we purchase the forklift, it's not just going to affect this year. So even though we're typically on a cash basis oftentimes for a small business, when we have something that large, then we don't really we moved from the cash basis to an accrual basis in essence. We say, hey, the forklift is an asset. We're not just going to write it off as an expense when we purchase it because we know we're going to use it for multiple years. That's the kind of common accrual thing that we would do, even though we might default to a cash method just because of the size of it. If we were to purchase something even larger like a building, you can see it's even more extreme. You can see, okay, if we buy a building, we can't just expense the $100,000 building. That would look really funny. Really, the building's going to be used for a long time, so we put it on the books as an asset. That's the conceptual concept of why we would put it on as an asset and then expense it when we use it, allocate the cost to the useful life. That makes the most sense from a financial perspective. And that's what we'll do for taxes as well. And we'll start from that concept, but then we'll often have some accelerated depreciation methods and whatnot that will be put in place really so that we can get other incentives, stimulate the economy in some type of way, give incentives for purchases and this and that. So start with the concept of depreciation being large purchases we can't expense in the current year, even if we paid for it in the current year, those that we put on the books as assets. Then we allocate the cost as we consume or use those assets over the useful life. That's where we start off with depreciation. Those expenses are going to be deductible for the most part because for more accounting information and accounting courses, visit our website at accountinginstruction.info. They are ordinary and necessary. So what do we need to calculate depreciation? Well, if we got that forklift, we need to know the cost or the basis of the forklift. We need to know the depreciation periods, the asset class lives. Now, if we were talking about financial reporting, then the life of the asset, how long are we going to use the asset, is something that we might be able to determine and have more flexibility with. In the tax code, it's pretty well laid out. We go in and we look up what the class lives will be depending on the type of equipment that we have. So they're going to be more defined in the tax code. So in other words, what's the useful life? That's going to be kind of like the class lives. How long will we have this? How long will it be used in the business? And again, we don't get to determine that necessarily for taxes. It's going to be something based on the type of the class of the equipment that we have. It will be determined for us. And that's going to be similar to the useful life. Depreciation convention. So what type of convention are we using? Half year, mid-quarter, mid-month. We're not going to get too much into the details of this, but just note that we're going to have these questions. You can ask a question, well, what if I bought the forklift? If I bought the forklift in January, then I have a full year of depreciation that I can calculate for that year. I've used it for an entire year. I should be able to expense a year's worth of use, a year's worth of the cost of that forklift. But what if I bought it, in December or something like that? Then we could say, okay, we have to take it down to the day and the hour and have some kind of ratio of the year, and you only get that much of the depreciation. But the tax code usually simplifies it a bit. So they might just say some, depending on the type of property, might have a half-year convention. So it doesn't matter if you bought it in January or you bought it in December. We're going to assume, just for the purposes of simplifying the calculation, that you bought it in the middle of the year. and therefore you have a half a year that depreciated in the first year of purchase, no matter when you purchased it. And so a mid-quarter would be whatever quarter you bought it in, we assume that you bought it in the middle of the quarter. And then a mid-month convention is going to say basically, we don't care when you bought it in the month, the beginning of December, the end of December, we say you bought it in the middle. And that'll just make the ratio calculation a lot easier to do. So those are just going to be our conventions, our assumptions as we do the calculation. Note that we're going to report this on Form 2106 and the Schedule C. So we're going to have Schedule C, which is going to be our business income. So if we have our forklift, we used it, we bought it, but we don't get to depreciate the whole thing. We don't get to just write off the $20,000 or $30,000 forklift in year one. We have to put it on the books as an asset and then depreciate it. That depreciation is going to go on the Schedule C as an expense, lowering our income, making a deduction for us. But it's also going to be calculated on the Form 2106, where we calculate or see the calculations of, or the groupings of at least, the depreciation. Then we need to consider, well, what is the basis amount? And typically the basis amount, and the basis amount is what we're going to use in order to calculate the depreciation. And usually the basis just is another word for cost. Typically that's going to be the case. If we went out and we purchased a new forklift, whatever the cost of that forklift is the basis. However, there are situations where that might not be. And notice when we talk about the cost as well, it could have been purchased in the cash portion, or we could have financed part of it. Either way, it's still going to be part of the cost of the forklift. That's what the basis is going to be. That's what we'll use for the depreciation calculation. However, we could have a situation where the owner put the forklift into the business on their own, meaning we didn't purchase the forklift, but we started a new business and took our personal forklift that we had or whatever on the business and put it into the business. Well, now, how do we put that forklift on the books? We didn't just purchase it. What's going to be the amount that we put it on the books for? Typically, it's going to be the fair market value. We'll put it on the books for the fair market value, unless the fair market value is greater than the cost, what we actually purchased the forklift for. So in other words, if we purchased the forklift 10 years ago, we're not going to put it on the books at cost because it's not worth that amount at the time that we transferred it to the business. It's worth whatever it's worth. It's fair market value. However, if it's some unusual circumstance where the current fair market value is actually greater than what we paid for the cost, then we're going to put it on the lower of the two. We'll put it on at cost in that case. And then we could have inherited property. What if we had inherited property? This would be more of an unusual circumstance, but that would be the fair market value at the date of death. So typically that's going to be the case with inheritance. And the idea of that is usually that, if there's inherited property, if it was going to be subject to tax or whatever, it would have been taxed at the estate level during like a death tax. So when the recipient receives it in terms of an inheritance, they're going to get it at the value of the time at that point at the date of death. So what are going to be some common depreciation periods? Now remember, when we think about depreciation periods, we're kind of thinking the useful life. How long are we going to depreciate this item over? If we got a forklift or something, how long do we depreciate it? What's the life that we're going to depreciate this for? It's not something that we can just determine. We have to see where it falls in terms of the tax code. So typical kind of rules or typical type of depreciation methods would be like 3 years for something like special tools. A lot of stuff falls into 5 years, like autos, trucks, and computers. So that's just what it is. It falls into that category. Then we're going to have the 5-year depreciation, 7-year depreciation period for furniture, fixture, and equipment. And then the 27.5 years, that's going to be for residential real estate, which differs from the 39 years if we're talking about non-residential real estate. So if we get into real estate, then of course we're thinking about the 27.5 and the 39, depending on if it's residential or non-residential. Now we'll consider the depreciation methods. How do we depreciate these items? We're going to use what's typically called makers for depreciation for the tax code. So just remember that the tax depreciation is going to differ from the books. So we have to use the tax code depreciation methods. Typically it will differ unless we have the books on a tax basis, which could be the case for small businesses. So small business could choose to run their books basically on a tax basis. But usually when we think of depreciation in terms of bookkeeping, we think of the straight line method or double declining method. For taxes, we got to think of whatever's used under the tax code, which is typically makers. What is makers? Well, it's usually a form of double declining balance, oftentimes. And if we think about the depreciation methods, notice really you kind of start with straight line. You'd say, what is depreciation? Well, if we had a $100,000 property and we said it was 5-year property, we would divide it by 5, and we would say we would depreciate $20,000 per year. That would be the most simplified method. The double declining method, we won't get into all the details on it, but in essence, it's accelerating so that the first year we're going to depreciate more. So if we have a 200% declining balance method, that's kind of like a double declining method, meaning we're going to depreciate more in the first years than in the later years, and then in essence switch to straight line at the end to so that it all evens out. It's not a perfect math situation, actually, the double declining balance. So in essence, we're just going to depreciate more at the beginning. Why would we do that? Well, it makes sense because usually when we buy the forklift, if we drive it off the lot or whatever, we usually lose more of the value in the beginning anyways. But it's also a type of incentive because it's going to be allowing us to deduct more in the beginning years. So for taxes, it might incentivize people to buy more stuff if they get to deduct more of it in the beginning years. And so it might be a tax incentive as well. Or 150 declining balance that converts to the straight line or straight line method. Those are kind of the conventions that would be used under the tax code, which would typically be under a maker's type of depreciation method. For more accounting information and accounting courses, visit our website at accountinginstruction.info.